Welcome, everyone. My name is Heather Knutson. I'm the Director of Marketing here at HomeSphere and want to thank everyone for attending today's event presented by our partners at Morgan Stanley. Today's topic is the current outlook for the U.S. housing market. And HomeSphere has worked alongside our partners at Morgan Stanley the last 2 years on the Residential Home Builder Survey Initiative, and we're going to touch on some recent month survey results towards the end of today's presentation. So if you're a builder in our network who has taken the time to participate, we wanted to pay you a special thank you. And if you haven't participated to date, we encourage you to do so in February. The surveys are sent out the first week of each month, so keep a lookout for those. And the published survey data results are exclusively offered to those participants who participate with us. As an added bonus, we give away an iPad mini to one randomly drawn participant, and typically we've got right around 100 participants each month, so your odds of winning a great prize are really good. We know today's topic is of great interest as we welcome over 500 attendees registered for today's event, and our guest presenters are Jim Egan and Ryan Gilbert. Jim is a VP on the Securitized Product Strategy team at Morgan Stanley. He's the head of U.S. non-agency RMBS strategy focusing on legacy, credit risk transfer, and is the co-head of U.S. housing strategy. It's quite a title. In addition, Jim co-covers single-family rental securitizations, and prior to working in research, Jim worked as a trader in Morgan Stanley's Securitized Products Group. So welcome, Jim, and alongside Jim is Ryan. Ryan is an equity analyst in the research department at Morgan Stanley. Ryan has nearly 5 years of equity research experience and has been covering the home builder sector since 2012. So we're happy. Thank you for working with us at HomeSphere. We're proud to be in this partnership, and to be considerate of everyone's schedules, this should be right around 30-45 minutes today, so probably under the hour we have scheduled. We will leave some time for questions for Jim and Ryan, so please use the GoToWebinar question feature. Let's get to the main event. Jim, I think you're kicking things off for us today, so the floor is all yours.
Thank you, Heather. As Heather said, one of my roles here at Morgan Stanley is as co-head of U.S. housing strategy, and so under that I'm going to give you an outlook for kind of how we see the housing market in the year to come. Now first we're going to start back on 2015, and when all is said and done for 2015, and we're almost there, we have most of our activity data through November at this point, and we believe that housing is going to have been one of the few consistent bright spots for the U.S. economy throughout the year. Thus far, home prices are up 5.4% on a year-to-date basis. Now, we do expect a little seasonal sluggishness. That's non-seasonally adjusted data. So as we get November and December home price data, we think it's going to finish the year right around about 5% appreciation, but that's still pretty good for the year. During the first 11 months of 2015, existing home sales are up by 5.1%. New home sales are up 13.4%. And housing starts and building permits are up 11% each. A major reason for this improvement in home prices and housing activity metrics is the notable pickup in the rate of household formations, which is going to be our chief barometer for demand in the U.S. housing market. And on the other hand, one weak link in the otherwise strong U.S. housing story has been the tepid growth in mortgage credit availability. We have long contended that we do not expect any substantial changes in housing policy to change the trajectory of mortgage credit availability, and that any improvements will only be slow and gradual. And that has proved to be the case. So let's get back to household formations. After being dormant in the aftermath of the financial crisis, household formations have finally returned to and are in fact significantly exceeding long-run averages. So long-run averages for household formations, we're talking about 1 to 1.1 million annually. Throughout the recovery, we were only seeing 300 to 700,000 households. Over the past 5 quarters, we've rebounded to well above that number, and in the 12 months ended September of 2015, we're at 1.3 million household formations. As we look ahead to 2016, all signs point to robust household formations continuing. The lack of formations throughout the recovery has resulted in substantial pent-up demand. In fact, if we assume the trendline growth in household formations from 1990 through 2003 were to have remained the same throughout the bubble and the recession period, we would still be 2.5 million households shy of where we should be, despite the growth we've seen over the last 5 quarters. And that doesn't even take demographics into account. The millennial generation is the largest generation, in terms of absolute numbers, that this country has ever seen. And they're currently entering the age cohorts typically characterized by the most rapid household formation. In addition to being the largest generation, the millennials are also the most diverse that any generation this country has seen. And that diversity has an impact on our outlook for both household formations and homeownership rates. But back to numbers for a second. Considering the sheer size of the population transitioning through their 20s and early 30s, it's difficult to envision household formations falling back below long-term averages And thus our base case for 2016 is 1.25 to 1.3 million new households, again in excess of that 1.1 million that we're going to call long-term averages. If we continue to see gains in both employment and income for these age groups, the rate of household formations could surprise to the upside. While on the other hand, the bear case involves affordability getting even worse from here, as well as the economy rolling into a new recession. Again, this is not our base case, but that would likely negatively impact the outlook for both employment and wages. And even under this scenario, again, given the sheer size of this millennial generation, we see household formations of roughly 1 million, maybe just a little shy of 1 million in 2016. Now, a household formation represents demand for shelter. Now, that could be ownership shelter or rentership shelter. At the beginning of 2015, the home ownership rate stood at 64.0%. As household formations increased throughout this past year, tight mortgage credit conditions that I mentioned at the onset forced a substantial amount of new households into rentership. And by June, the home ownership rate had reached a 48-year low at 63.4%. Without easier lending guidelines, the majority of the 1.25 to 1.3 million new households that we are projecting to form next year, or this year, 2016, will also be rental households. In addition to mortgage credit availability, other borrower characteristics can provide hints to what the future of homeownership rates could look like. All else equal, a younger household is less likely to own, as you can see on the chart on the left-hand side of this slide. And the diversity of the millennial generation also has ramifications for the future of the homeownership rate. As people of different ethnicities tend to have very different ownership tendencies, the more diverse the population becomes, the more downward pressure that's going to apply on the homeownership rate, as you can see on the right-hand side of this slide. I wanted to take 1 minute to look a little more closely at the age distribution of the population. While the millennial generation is indeed the largest in absolute terms, it would be a false claim to assert that this country is getting any younger. If you look at the exhibit on the left-hand half of this slide, we take the U.S. Census Bureau population projections over the next 5 years to show that despite the size of the millennials, the largest changes are actually coming from baby boomers. Now, this has less to do with the size of the millennial generation versus the baby boomer generation. As I mentioned earlier, the millennials are the largest generation this country's ever seen. It has more to do with the size of Generation X versus the silent generation, as the boomers are replacing a much smaller generation as they age, which is what drives the impact that you're seeing on the left-hand side of this slide. Now, in a vacuum, this aging of the population should be putting upward pressure on homeownership rates. But where household formations are coming from depends on how you calculate them. In the chart on the right-hand half of this slide, we take household projections from the Joint Center for Housing Studies at Harvard University to illustrate this point. For example, column A in the exhibit simply subtracts the number of households an age cohort is responsible for in 2015 from the number of households for that same age cohort in 2020. If we use 70 to 74-year-olds as an example, they will be responsible for 2 million more households in 2020 than they are today. Column B offers a different way of looking at the same data. The people who will be 70 to 74 in 2020 are not the people who are 70 to 74 today. They are the people who are 65 to 69 today. Today, those 65 to 69-year-olds had 9.7 million households. By the time they are 70 to 74, the Joint Center for Housing Studies projects their household count will fall by 630,000. When looked at this way, household formations really do appear to be coming from the younger generations. Now, if we take all this into account, the aging of the population, but the likelihood that future household formations are going to come from the millennial generation, the growing diversification within that population, and the prevailing tight mortgage credit conditions, we project that homeownership rates are going to continue to fall from here and end 2016 roughly around 63%. Okay, so if we're calling for a continuation of the robust household formations we've seen over the past 5 quarters, and a further drop in the homeownership rate, what does that mean for home prices and housing activity? Let's start with home prices. Home price appreciation should continue to moderate in 2016. From their trough in the first quarter of 2012, home prices have appreciated meaningfully. However, we do not think this represents a bubble in U.S. home prices. In our view, there's a notable difference between current housing valuations and what prevailed in the pre-crisis period during the mid-2000s. Using our econometric model to project home prices, and this is driven by the auto-regressive nature of home prices themselves, the momentum factor in there, pending home sales, and the shadow inventory, we project home price appreciation to be right around 3% for 2016 in our base case. Now, I won't spend too much time on the next slide, existing home sales here, but the high-level takeaways here are that higher home prices, positive trends in employment, and the demand from the robust household formations we discussed earlier will push existing home sales higher in 2016. However, this increase is going to be somewhat mitigated by falling distressed transaction volumes. The shadow inventory, what we're going to look for as the supply for distressed transactions, has come down almost 70% from its peak levels at the beginning of 2010 to sit at about 2.8 million households today. So given that lower level of supply, the sheer volume of distressed transactions which feeds into existing home sales will have to be lower. And in addition to the constrained mortgage credit availability environment that I've already mentioned a couple times on this call, that will provide mitigating factors to existing home sales. We have it at 5.25 to 5.5 million next year. So let's get into new home sales. On a year-over-year basis, new home sales are up more than any other housing activity metric we track, at 13.5% through 11 months. However, they remain substantially below long-term averages. Compared to the pre-crisis, pre-bubble period averages of 2000 to 2003, and now not the boom years from 04 to 07, but we're talking about 2000 to 2003 that a lot of people would consider more of an equilibrium housing market, new home sales are about 49% lower through the first 11 months of the year. Looking ahead to 2016, we believe there are tailwinds from the growing supply of new homes available for sale. And given the strength in single-family starts this year, in 2015, this past year, that supply should only continue to grow looking into 2016. At the risk of sounding repetitious, we note that the increased rate of household formations should provide a boost to demand, even if a majority of those households will be renters. We expect sales figures to continue higher in 2016 and finish in the range of 575 to 600,000. Though this is a far cry from the levels of the pre-crisis, pre-bubble period, it is an increase nevertheless. Now, an increase in new home sales and robust household formations are positive developments for housing starts. Year to date, starts are up 11% and should finish 2015 about 1.1 million starts in total when we get December's numbers. But they remain heavily skewed toward multifamily. Historically, multifamily starts make up roughly 15 to 20% of the monthly number. In 2015, their share has been closer to 35%, a manifestation of the drop in homeownership rates. Looking ahead to 2016, continued formations are going to drive a need for higher housing starts, and we believe they'll approach 1.3 million. However, given our view on homeownership rates, we believe the ratio will remain skewed toward multifamily and project the ratio to remain right around 35% multifamily and 65% single family. Finally, when it comes to mortgage credit availability, which I mentioned a few times here, we only see it easing on the margins in 2016. The Mortgage Credit Availability Index from the MBA, which we show on this slide, shows lending standards they're almost at their loosest conditions since the crisis. It's pulled back slightly from October, where it was at its loosest conditions. However, when we extend that index back to 2004, which you can see on the right-hand side of this chart, we are well shy of pre-crisis levels, well shy of 2004, not to mention what we saw in 2005 and 2006. If we look at weighted average FICO scores, the credit scores that determine the credit quality of borrowers getting mortgages today in GSE and FHA purchase originations, we get a very similar story. Average FICO scores have barely budged over the past few years, either in GSE or FHA pools. The overhang of mortgage litigation and the consequences of regulatory changes continue to cast a shadow over lenders. We are optimistic that higher home prices, better labor market conditions, and low interest rates will contribute to expanded credit availability on the margin, although that expansion may be limited, and our base case is for it to only happen at the margins. With that, I'm going to hand it over to my colleague Ryan Gilbert in Equity Research.
Thanks, Jim. And just before I get started, I want to remind everyone that for important disclosures, please see the Morgan Stanley Research Disclosure website at morganstanley.com/research disclosures. So with that out of the way, I'll get started. I'm the home builder analyst at Morgan Stanley. I've spoken with HomeSphere a couple times now, and so I wanted to talk about, I guess, just some upside constraints on the supply side to our housing projections, as well as two topics that we discussed in August, which was the return of the first-time home buyer and whether we should fear a rise in interest rates. And then lastly, I'll go over the results of our most recent survey of home builders, which we published this morning. So Jim talked about mortgage credit constraints. Not really easy, and we see that as an upside limitation to our housing estimates. Now, on the supply side, we're looking at shortages of land and labor availability as limiting upside to the 2016 growth story from the supply side. So one way to measure or to look at land shortages would be to look at the employee to permits ratio. So that looks at growth in employment in a market relative to growth in permits. So builders' ability to meet higher levels of demand with more housing supply. And so what we did to determine whether markets were constrained or not was to look at the 2014 and 2015 employment to permits ratio and compare that to the pre-crisis average, with the idea being that if a market was in equilibrium, the ratio would be around 100. So this is the chart on the top left, and you can see the black line where 100 should be. And what we see here is that almost all markets are well above their pre-crisis averages, which is led, unfortunately, by my hometown of San Diego, and the employment to permits ratio has only deteriorated. It's moved higher in 2015 from 2014. At the national level, the employment to permit ratio is 4.5 in 2015 versus 1.2 pre-crisis. But the good news is that we have seen some improvement in this ratio in 2015, which the chart on the bottom left shows. So this compares the 2015 ratio to the 2014 ratio. What we see is that 55% of the 30 markets that we looked at improved from 2014, is led by Houston, although in this market it's more due to decelerating employment growth rather than permits growth. But in the rest of the markets that are showing year-over-year declines, it's due to an increased ability to meet higher levels of demand relative to 2014. And so interestingly, two markets stand out on the tightening side, so markets that have gotten tighter and more constrained, and that's Washington, D.C. and Tucson. Washington, D.C., the employment to permits ratio is up 200% in 2015, and in Tucson it's up 132%. And what's happening here is that that job growth was very weak in 2014 in both of these markets, but bottomed, and in 2015 saw a pretty strong improvement, and that improvement hasn't been registered in the permits data yet. The chart on the top right is sort of the same idea as the top left, using data that we have from Metro Study. The metric here is months of housing supply. We compared average months of supply in 2015 to average months of supply in 2005. And what we found is that in most of our markets, months of supply are below the 2005 average, led by Minneapolis, Miami, and Sacramento. So moving on to the next slide, we're looking at labor shortages as a supply-side limitation. So residential construction employment and residential specialty trade employment remain 30% below their pre-crisis peak levels, which you can see on the chart on the left. And then the results of that are on the chart on the right. So labor shortages have been a persistent issue throughout the recovery, and they've really intensified in 2015 and in the back half of 2015 in the summer and fall. So what we're looking at on the chart on the right is backlog conversion in 2015 relative to 2014 from large public builders. And backlog conversion is a measure of build time or ability to build homes and deliver them from their backlog. And so what we're seeing is that, with the exception of D.R. Horton and Toll Brothers, all the builders have reported significant year-over-year declines in backlog conversion in 2015 relative to 2014, which they attribute mostly to labor shortages as well as poor weather in some of their markets. So again, slide 15. Fortunately, we're seeing some improvement on the labor shortages side. Growth in residential construction employment and residential specialty trade employment has accelerated in the fall, which the chart on the left is showing you. So if you look at the red dotted line, you can see that starting in September, we're seeing some reacceleration of the growth rate of employment for residential construction workers. And that's likely in response to accelerating wage growth, which you can see at the chart on the right. So residential construction wage growth has really accelerated. It's up 6%. Specialty trade contractor wage growth is up 2.5% in November. And we included the overall construction number here to show you that the trend continued in December from September. Or I'm sorry, from November. All right, so moving on. So the two topics that I wanted to discuss, we originally talked about in August, but I think there's been some interesting developments that I wanted to go through. So the first is the return of the first-time homebuyer. The second is going to be the effective interest rates on housing demand. So this first slide is showing you developments in the first-time homebuyer market. In August, we thought that the return of the first-time homebuyer would be more of a catalyst for 2016, or more pronounced in the new home sales market in 2016 rather than 2015. And so the chart on the left is showing you new home sales by price point over the past decade, and this is data from the Census Bureau. And the idea here is that the first-time buyers are most likely to be concentrated in the sub 200K price point and the 200 to 300K price point, which are the dark blue line. The dark blue line is sub 200K, and the light yellow line is 200 to 300K. So what we saw in 2015 was that the sub 200K price point saw some improvement in demand, but it still remained negative throughout the year, at negative 6% in November. So sales of homes below 200,000 declined 6% in November from November a year ago. We did see some improvement though in the $200,000 to $300,000 price point in 2015, which is that light yellow line, and you can see that it went from flat growth in the beginning of the year to plus 20% in November. So pretty encouraging results there. I think that a lot of the weakness at the sub $200,000 price point is probably due to lack of inventory more than lack of buyer demand. There's only a couple public builders that are really targeting this price point, and we've heard more interest from builders to get involved there, but it hasn't really showed up in the census numbers yet. So an inventory view, or a lack of inventory view, is evident by results that we can see in the resale market, so the existing home sales market, which is the chart on the right. Shows you first-time homebuyer growth and the resale market, and this data is from the National Association of Realtors. We created it by multiplying the first-time buyer percentages, which is reported monthly, by the total number of resale sales. So growth in the first-time buyer in resale turned sharply positive in 2015, which I believe we discussed in August, and has improved throughout the year. The trailing 12-month growth rate in November is 15%. So we're clearly seeing demand from first-time buyers in resale, which is a lower price point than the new home market. And what's causing the first-time buyer to return to the market? So in 2015, we're seeing improvements in affordability for all home buyers, but particularly for first-time home buyers. So what we're looking at are debt-to-income levels over time relative to their long-term averages. So the blue line on the top right would be debt-to-income levels for all buyers. The yellow line is debt-to-income levels for first-time home buyers. And what you can see is that both measures are currently below their long-term averages. In January of 2015, the FHA cut mortgage insurance premiums by 50 basis points, and the first-time homebuyer debt-to-income level fell to 21%, which is the lowest level in our data set going back to 1990. So the chart on the bottom right, you can see the blue line really dropping in January 15 and moving a little bit higher throughout the course of the year as mortgage interest rates increased. And the improvements in affordability that we saw in 2015 have clearly been a positive driver for demand. While this is a positive development, we do note that first-time homebuyer debt-to-income levels are more sensitive to a rate increase, just because they're a more leveraged buyer than the typical home buyer. And we're seeing this chart. We can see this in the charts on the bottom left and the bottom right. So it's only going to take a 100 basis point increase in interest rates to move debt-to-income levels above the long-term average for the first-time home buyer. It would take a 200 basis point increase in interest rates for a comparable move in all buyers. And so that's what the chart on the left is showing you. The purple box is the debt-to-income level, assuming a 200 basis point increase from current levels. And you can see that moves all buyers above their long-term average, but it would only take 100 basis points for first-time buyers. So the second topic would be, should we fear an increase in interest rates, or how will interest rates higher interest rates impact demand. And the chart on the left really encapsulates the experience of buyer demand to higher interest rates as well as higher home prices, and it's a little complicated, so I'll just briefly explain it. The blue bar is mortgage payment growth from 2011 to 2015 from a year ago, so it's the year-over-year growth rate in mortgage payments. The yellow line represents total growth in new home sales, and the gray line represents public home builder orders growth, so it's like the public builder equivalent of new home sales. And what we saw in 2013, you had very strong home price appreciation. You had a 100 basis point increase in interest rates in the space of a month. And that was a shock to home buyers because you saw mortgage payments increase from basically flat to negative growth in 2012 and 2013 to over 20% growth in the summer and fall of 2013 and going into 2014. And that caused new home sales growth and orders growth to decelerate from 20 to 30% growth to flat growth throughout 2014. So in 2015, the changes in mortgage payment growth have been much more moderate due to more moderate changes in interest rates as well as decelerating home price appreciation that Jim talked about earlier. And we've seen both new home sales and public builder orders pick up as a result of that. And then the chart on the right shows you sort of how interest rates and new home sales have trended over the past 30 years, 30, 40 years. And you can see that over the long term that these two indicators are not correlated. So why was 2015 different? As I said earlier, we have a much more moderate increase in interest rates in 2015, which the chart on the left shows you. So these are mortgage rates. In 2013, you saw that the 30-year fixed-rate mortgage went from 3.5 to 4.5 in the space of about a month, which was a shock to potential home buyers. In 2015, we've seen much more moderate moves in the 30-year fixed-rate mortgage. And then we had a significant deceleration in home price appreciation as well. This shows you the FHFA purchase-only index, so the year-over-year change in home price appreciation from the FHFA, as well as the Case-Shiller 20-city composite. So the Case-Shiller was home prices were appreciating at 15% growth in 2013 and 2014. That's moderated significantly, and we're running around 5% currently. And as Jim said earlier, we expect that to continue to decelerate to 3%, which is going to provide more support to home buyers and mortgage payments in 2016. So this chart shows you 3 different scenarios for mortgage payment growth. We think that the most likely scenario in 2015 is somewhere between the light blue line and the green line. So pretty moderate increases in mortgage payment growth, which should support the housing market. You'll notice that even our sort of worst case scenario, the yellow line, we're expecting a much more gradual trend than we saw in 2013, where it's basically mortgage payments shot straight up. All right, so moving on to the results of our most recent survey of home builders, which we conduct with HomeSphere. The December results were published this morning. We included a special question this month on the impact that builders are seeing from labor shortages, just given how they've intensified over the past several months. 74% of builders responded that they were impacted by labor shortages, of which 34% reported being impacted both by longer build times as well as lower gross margins, which is interesting to us because we think that the focus has really been on build times and has not been on margins. So it suggests that that the story has yet to fully play out. On the right, we can see top concerns. The rising cost of building materials has actually overtaken labor shortages as the top concern for the first time since June of 2015 at 48%. 40% of home builders still see labor shortages as a top concern, followed by 35% lackluster job creation and 31% higher interest rates impacting buyer demand. Slide 22, we survey builders about the inning of the housing recovery as a way to sort of gauge where we are in the housing cycle. And throughout 2014 and 2015, we've seen a move away from builders who think that we're in the early innings of the housing cycle towards builders who think that we're in the middle to late innings of the housing cycle. In December, we saw a move away from the late innings. So 30% of builders reported that they felt that they were in the late innings of the housing cycle versus 41% in November. What was interesting is that the level of uncertainty also increased going into the end of the year. So 24% of builders said they weren't sure or didn't know what inning of the housing recovery that they were in, up from 18% in November, and 24% is actually the highest level since that we've recorded since we began surveying. All right, slide 23 shows measures of current volume. So new home sales rebounded somewhat in December after a slowdown in the fall. So you can see from August to November, builders reporting higher new home sales declined to 40% from 66% in August. We had a little bit of a turnaround in December, so 47% of builders reported higher new home sales from 40% in November. Traffic was essentially flat. 42% of builders reported higher traffic levels from 43% in November. We think these are encouraging results because it shows some stabilization in demand after a sluggish fall, with both declines in builders reporting higher new home sales and builders reporting higher traffic levels. Slide 24, the outlook has been pretty stable over the past several months. In December, 69% of builders expected higher new home sales in the next 6 months from 70% in November, which are positive results as we head into the spring selling season, so some firming of expectations heading into the spring. The gross margin outlook has been trending towards flat growth and away from declines that we saw earlier in the year, which culminated in August of 2015 when 34% of builders said that they expected margins to be lower in the next 6 months. That's now moved to 20% of home builders in December. 55% of builders expect flat margins over the next 6 months, which is the highest reading since April of 2014. The results from this measure are positive in the context of the declines that we've seen from public builder gross margins in 2015. All right, so these are the components of gross margin. New home price expectations and buyer incentive expectations have been pretty flat through the fall. 64% of builders expect higher new home prices in the next 6 months, and 72% of builders expect flat incentives use. But the relatively positive price outlook is offset by the cost outlook, which this slide is showing you. So 70% of builders expect higher materials and labor costs. 63% of builders expect higher finished lot costs, and 50% of builders expect higher raw lot costs. So we're seeing that the expectation of higher prices is being offset by the expectation of higher construction costs. Although we do note that the land cost outlook has improved moderately throughout 2015, which may indicate that there could be some more land buying opportunities as we move into 2016. And then lastly, on a sequential basis, so this is looking at how pricing, incentives, and costs trended in December relative to November of this year. We see a trend towards flat pricing and incentives. So 68% of builders saw flat pricing in December relative to November, and 78% of builders saw flat incentives use, and we saw the same thing on the cost side. So there's been a big move towards flat costs in December. 66% of builders reported flat materials and labor costs. 68% of builders reported flat finished costs, and 67% of builders reported flat raw lot costs in December from November. So that wraps it up for me, and I'll turn it back to Heather for any questions that you may have. Thank you.
Thanks, Ryan, and thanks, Jim. Great job to both of you. I know everyone really enjoyed your slides because I probably answered about 20, 30 questions of, can I have the slide deck? So just one housekeeping item, we're not able to share the slide deck. The information is confidential. However, they do allow us to upload a recording to our website, the video section of our website, which is www.homesphere.com. We'll have that there by end of day Friday, so I encourage you if you want to revisit. There's a lot of great information, and I know it's a lot of information we go over pretty quickly here in 30 minutes. So we'll send everybody a note at the end of attendance and let you know as a reminder where to find that. So we did have a couple other questions come in, but Jim and Ryan, if okay with you, I thought it'd be kind of cool if we announced the winner of our January participation for the iPad, and that is Ann Coffin from BRB Construction Services in Conway, South Carolina. So Ann, if you happen to be attending today, thanks so much for participating in our monthly survey, and we look forward to awarding another iPad here just next month. So keep an eye out for that. And one more item, we did have a couple questions come in, and I think you've got time here, Jim and Ryan. If the first question that came in, I know you guys are going to be on speakerphone there, so I'll let one of you take this, and I think it's a great question, is do you think that condos are going to be the future for millennials?
I mean, we have seen more demand for condo and attached product. I'm not sure that ultimately it's going to be the future. I think that there's still a lot of, I think as millennials get older and their priorities change from being close to the city to having a larger home with more land so that they can raise kids and have space, I think you're going to see preferences change as the millennials get older. So I think currently, and for the next, call it 5 years, there probably will be more demand for more infill condo and attached product. But over the long term, I don't see, as the millennials get older, I don't see their preferences changing in a really strong way from previous generations.
And just to follow up on that, we have seen survey data where millennials do tend to exhibit the same sort of traditional home ownership tendencies of generations before them. They're just a little more delayed in that decision, as Ryan was saying.
Okay, great, good information. A couple more questions coming in. One item though, if it's not too much trouble, you guys, is it possible to go back to slide 1? We have a few people looking for that slide specifically. So if you're okay with that, let's roll back up to that so that the few people inquiring can look at that while we answer some questions. And I know remodeling is a big topic. I know we're going to be working together at the Builder and Remodeler Expo in March, which we'll talk about at the end in Atlanta. It's a brand new East Coast trade show. So I think we're going to see a lot of remodeling talk then. And so this question is, what insights can you provide to the remodeling spending on existing family homes?
That's not a topic that I specifically cover. We do have equity analysts that cover that. I don't know if Brian has a specific comment on that as well. But
I mean, I think that just given the improvements that you've seen in existing home sales and our expectation that existing home sales will continue to grow, as well as the improvements that we've seen in tappable home equity, that as home equity lending increases, you're going to see improving and continued growth and demand for remodeling projects and home improvement projects.
Great.
As long as existing home sales are moving higher, the home improvement and remodeling space should do well.
Perfect. This is a land-related question. For land opportunity, how long do you think builders will be interested in developing?
Until private land developers start doing it. I think that the preference for every builder is to buy finished lots over raw lots, or to hold raw lots in option contracts and let a private developer develop. What we've heard from builders is that they're really seeing no improvement in the finished lot market. So I think that I think that we'd prefer to see them buy finished over raw lots. But I don't expect really, unless we see private developers really jumping back into the market, which seems relatively unlikely just given the financing constraints. I think builders are going to have to continue to buy raw land and self-develop.
Okay. We're circling back to another millennials-related question here, and I'm not sure if you guys have this data, but I'll ask the question. The question is, do you have any data to indicate how far millennials are willing to live away from their main work location?
I don't think we have specific data on that.
Yeah, we don't have anything that would specifically address that.
Okay. I know we're seeing that trend, but I didn't know if you had any data to share, so appreciate that answer. And you guys are talking about interest rates. What, if any, impact do you see with recent and future Fed actions as they relate to interest rates?
Sure. So I think part of the question there is how much higher are mortgage rates going to go, the back end of the Treasury curve going to go for the Fed raising short-term front-end interest rates. And while we do believe in our base cases for mortgage rates to increase slightly this year, it's not for greater than a 10 or 20 basis point increase in mortgage rates. I mean, and Brian highlighted some of the work we've done on affordability and debt to income for first-time home buyers and all buyers. And even a 50 basis point increase in mortgage rates isn't enough to bring us back to long-term averages there. So while our base case is for the mortgage rates to increase this year, given Fed action, the house call from the economist's perspective is for any kind of rate hikes going forward in 2016 to be gradual. We believe any increases in the mortgage rates will also be gradual along with that, and a gradual raising of the mortgage rates isn't going to be enough to threaten affordability levels.
Okay, great. And now that you brought this first slide up, it's begging a few questions that are coming in. So we'll go back to that here and looking at the starts specifically, and it may tie into your last answer. Just looking for some general comments on both the single family and the multifamily housing projections. Do you have any insight on how that will unfold quarterly, or will that be spread throughout the year?
So while our call does not have a month-to-month projection into how the 65% of single-family versus 35% multifamily is going to unfold, we do think that it's probably going to be closer to uniform, if not exhibiting a little seasonality on the single-family side towards the middle of the year, but not too much there.
Perfect. And we've got another kind of starts related question here, so I'm going to go to that here instead of skipping around. And it's talking about the difference between the 845 single family starts and the new home, the 575 to 600 new home sales. It seems like a little bit of a big delta. Can you guys maybe expand on that?
Sure. So part of that is the difference between starts and completions in the single-family space and the new home sales space. And part of it is the move we've seen, and I'm not saying that we're going to see an enormous move in build to rent, but we have seen an incredible, very significant increase in buy to rent, or not buy to rent, but single-family rentals. It's the fastest growing aspect of the housing market. It's gone from 30% of all rentals in 2005 when the home ownership rate was at 69.2%, so all rentals were 30.8% of the total housing market. 30% of those are single family. Now that rentals are almost or over 36% of the housing market, with the home ownership rate at 63.7%, single family rentals have been up to 35%. The number of households that live in single family rentals has increased from 10 million households to over 15 million households. So while that's not a big driver of that basis, it is partly there.
Yeah, just to add on to what Jim said, when you look at the single family starts number, around 70 to 75% of that number is going to be new homes built by home builders for sale, and that's what the new home sales number is. So if you look at 845 and multiply by like 70%, that's really what gets you into the new home sales range.
Thanks for expanding on that. You had a few questions that came in related to that slide, so I appreciate that, guys. I'm going to take one more question here, and then we'll wrap up by talking about a new show that we're both going to be at together, and you guys are doing the keynote, I believe, in March in Atlanta. So last question here, and I know we don't cover it in our survey, but I'm guessing you guys can maybe chat about this a bit, is any feel for oil's price decline and the impact on starts in oil patch regions specifically?
Yeah, I mean, it's been sort of interesting. The impact from oil price declines on housing has been pretty delayed throughout the year. So we've seen declining demand in Houston in the back half of the year, and we don't really expect, just given where oil prices are now, we're not expecting any improvement there in 2016. So we're expecting demand in Houston to continue to fall, and you've heard that from the public builders. It started out, demand was impacted at higher price points, moving down the price spectrum. So whereas in the first half of 2015, builders were talking about demand at the 350 plus price point slowing, now it's 250, and it's probably going to continue moving down the price spectrum throughout 2016. What's been encouraging is that the other markets in Texas have remained strong, and job growth has remained strong. Of the markets we track for employment growth, the second fastest growing market in the country right now is Austin, Texas, aside from, behind San Jose. And then San Antonio is right below that. So they were 3.9% and 3.7%. So it's pretty, Houston's, the largest home building market in the country, which is, going to present a challenge in 2016. But we've seen a lot of resilience from the other markets in Texas, which has been encouraging.
Perfect. Well covered, and that's our last question that came in. So I want to thank both of you. Thanks, Jim. Thank you, Ryan. We really appreciate your partnership and taking the time to do this with us. One special announcement, you guys heard me mention this as we dive into 2016. HomeSphere and Morgan Stanley are co-presenting the keynote at a brand new East Coast trade show coming up on March 7th in Atlanta. It's called the Builder and Remodeler Expo. We're really excited about that. I know they're targeting it's a new show, but they're targeting 400 exhibitor booths and 5,000 attendees. I do have a few complimentary expo passes in hand remaining, so if there's any builders on the line that are looking to maybe walk a new show and didn't want to make the investment out of the gate, first come, first serve, but my email will be shared with you after this, and you're welcome to reach out to me. I follow up with everybody personally on any questions that come in, any requests like that.